Hey guys, Dave Keller here with Market Misbehavior. Recently Apple and AMD, two stocks that have really been leading in 2023, have really started to diverge. Today we'll talk about that particular divergence, which of those may present a better opportunity given the short-term versus long-term picture, and what it means to have a fat pitch chart. So yesterday I went to my first Mariners game of the season with my family. We had a lot of fun. It was really cool to get out to the ballpark. Great summer evening here in Seattle. The Mariners lost to the Washington Nationals in extra innings, but let's not focus on the end of the game. Let's focus on the experience. Good lesson, life lesson for investing. Forget as much about the outcome and focus on your journey along the way. Although the outcome, as with baseball, kind of important too. However, let's have fun along the way, and that's what I definitely experienced last night. One of the things that you think about in baseball is what's called a fat pitch. Now, if you're not familiar with the game of baseball, a fat pitch is a pitch that's hanging over the plate, right? It's sort of the pitcher just kind of leaves it hanging in a perfect spot. And regardless of what the situation in the game is, regardless of what the conditions are and the situation, you just have to take a swing because highly likely you can turn it into a good opportunity of some sort. So a fat pitch is one of those just great setups you kind of want to take a swing at. We're going to look at two stocks today, Apple and AMD, both technology stocks in two different groups within the technology sector, but having both been strong year to date in 2023, there's actually kind of a difference, and they're diverging a little bit. We're going to look at that divergence and how Apple and AMD are actually moving in different directions, why one of them, I would argue, presents what we call a fat pitch chart or a fat pitch opportunity. Before we get to the chart and the ideas, by the way, if you like the sort of thinking about technical analysis, investor psychology, behavioral finance, breadth, sentiment, trend, momentum, go ahead and subscribe to my channel. Also, give the video a like if you appreciate it. We would super appreciate that back. Put a comment below. Which of these two stocks do you think presents a better opportunity and why? Drop a comment, let me know. Now here we're looking at the two different stocks, Apple and AMD. The top half is Apple for the last 2 years with the 50-day simple moving average. The bottom half is AMD with a same thing, 2-year daily chart with the 50-day moving average as well. Now, there are plenty of similarities, and not surprisingly, because these are two stocks in the same sector, both large cap names, if not mega cap names. So overall, kind of similar trajectory in 2023. Both have had a pretty strong year. Both of them are above upward sloping 50-day moving averages, and both of them made a new high for the year here in the last month, in June of 2023. However, from there, the similarities start to change a little bit, or we start to see some discrepancies between the two. Look at what's happened to Apple in the last couple of weeks, making new all-time highs and then pressing those highs, continuing to go to the upside, remaining a pretty far distance from its 50-day moving average. AMD, on the other hand, has actually pulled back, had what's called a bearish engulfing pattern there a couple weeks ago, and from now has pulled back to an ascending 50-day moving average. Here is the challenge with a chart like Apple. It is overextended. Now, how do we define that? What does that mean when we say something's overextended? Well, from a technical perspective, we have a number of different ways to measure the strength of a trend and how that trend and the strength of that trend is changing. We can look at things like the slope of the trend. We can look at the shape of the moving averages. We can look at a trend line connecting the previous lows. We can look at how far the price is from the moving average. We can look at momentum, something like RSI or MACD or something, to just sort of see how far away we are from the normal trend. We can look at Bollinger Bands and see how far we are from an average price over a period of time. Any of those metrics that I just described, for the most part, will indicate for most likely that Apple is overextended. And what we basically imply there is leaning, think of it if you know skiing, sort of leaning a little too far over the front of your skis, or you're getting a little too aggressive, a little too, you're moving a little too far too quickly. And as a result, pretty common that after you have a big run and you really start to accelerate, at some point, naturally, some of those people that have bought along the way, all sitting on paper profits, are going to start to say, this is a really good time to take some off the table and book some of those profits that we've experienced so far. Instead of just having them on paper, let's put them in the pocket. By selling, by taking those profits, that creates a short-term pullback often, as selling or need for selling or selling pressure overweights the demand, the natural demand of people that want to invest more. Now, in a bull market phase, what happens is every time we pull back, you get additional buyers coming in that missed out maybe on that initial move. All of a sudden, they see short-term weakness, and they see a great opportunity to buy in. If they maybe missed that first move, all of a sudden they can buy in on weakness. And that creates what's called the buy on the dips scenario. We'll come back to that in a minute when we look at the chart of AMD, by the way. So the argument for the chart of Apple is that the trend has been positive for so long. The argument against a chart like Apple is the fact that it's been going up for so long, right? It's at new all-time highs. That's in general not a bad thing. That's kind of what we want, right? But how sustainable is this move, right? What number do we get to where all the investors that bought through this 6-7 month period, which are all sitting on profits, start to say this is a really good time to take some profits? You haven't really seen it yet, but at some point we certainly will. And at some point the trend starts to reverse lower. So the challenge with buying a chart like Apple today is the same issue you would have had if you bought Apple in the peak in August of 2022. Imagine this is today, and imagine we're having the same argument. It's a nice run over the last 8 to 10 weeks, showing strength, testing resistance, but overall I think the trend is positive and we buy here. What happens is you very quickly rotated lower. You ended up being the last buyer. The anecdotal last buyer was you, and the price comes back down. So you can buy a chart like this in May, which is at the same level, where it's testing the same level of resistance, and it's in a very similar condition above the 50-day moving average and continuing to go higher. You can buy in each of these scenarios. In this case, you would have been very happy over the last 6 weeks as the price continued higher. In August, you would have been very disappointed or frustrated as you bought and then the price moved right back against you. So if you're going to buy in an overextended market already when the stock has already had a run, this is the risk that you repeat in August of 2022. And what happens there is you just get stopped out, right? You buy, it didn't work, you get stopped out, you move on to the next opportunity. If things work well, it's May of 2023 and you end up riding it higher and you just happily book those additional gains and move your stop up along with the trend. That's a challenging environment, and having worked with a lot of institutional investors, it's tougher to do that because you also, especially if you're buying a lot of volume of a particular stock, it's hard to be buying into a big uptrend because you're getting a worse and worse fill every time you try to get into the stock. It's way better of an opportunity to buy into some sort of short-term weakness. And this really creates what we call the fat pitch chart, in my opinion. The fat pitch chart for me has two main components, a long-term uptrend and a short-term downtrend. That's it. And how you define that could be up to you. I'll show you how I define it. Long-term uptrend basically means a clear pattern of higher highs and higher lows on whatever time frame you're looking at. So on this daily chart, sort of late 21 to fourth quarter of 22, clear downtrend, right? If you just use your finger or your mouse and track the peaks and valleys in the price, whatever makes sense visually, you'll see in general when you're making lows, you're making a new low, and then we make a lower high and a new low and a lower high. So each high undercuts the previous high, each low undercuts the previous low. And that trend continues until it doesn't. All of a sudden in January, we make a higher low and a higher high, a higher low, higher high, higher low, and you can see how this pattern kind of works. So right now, we've arguably pulled back and made yet another higher low out of all of these. So what's a better opportunity, buying into a stock when it's accelerating to the upside or buying into a stock when it's pulling back? This tends to be a much better opportunity because the trend is strong. Think of it as a channel, a trend channel, and instead of buying in at the upper end of the channel, you're buying at the lower end. Overall, if you bought in at the lower end of the channel, over time, your entry points are much lower, right? Your cost basis is a much better, more attractive level. And as a result, when we do resume that uptrend, assuming that's what happens, you're in a much better position because you had a lower entry point. This is kind of the idea. Now, why is a short-term pullback important? It's actually very interesting. The data, if you look at a lot of history of equity prices, and particularly look at quantitative models in the institutional community, talk about alpha models that are designed to outperform a benchmark. One of the common factors you would use is what's called the momentum factor, price momentum, just like what we would talk about looking at charts, just a quantitative way of calculating that. And one of the common measurements is 12 minus 1, meaning 12-month returns minus 1-month return. The best scores, the best momentum factor weighting would be, or the stocks that score the best for momentum factor will be the strongest 12 months and then a weak 1 month. And in a strong 12-month period, weak 1 month period would in general be the best opportunity. And the reason why that's what's built into most momentum models is because over time, that's what's kind of worked. Instead of buying into just blind strength, you buy into stronger charts or stronger trends that are pulling back, and you're buying in at the lower opportunity. And what that provides, besides just the fact that you're in a better entry point. In terms of the market itself, when you start buying, particularly if you have a larger portfolio that you're running, if you start buying in an uptrend, you can actually just accelerate this uptrend. Right? It just keeps getting worse and worse as the price goes higher. You're buying a weakness, there's a lot more opportunities, a lot more liquidity, and a good opportunity to get in. So institutions obviously practice this sort of approach, trying to buy at the lower end of a range so that you can benefit from the eventual upside. So if you're looking at two stocks like Apple and AMD, I would argue the best practice is to focus on what's called the fat pitch. Instead of buying extreme strength, stocks that are overextended, stocks that are already moving to the upside and haven't had enough of a pause in a while, I'd much rather buy what's called a fat pitch, which is a strong trend. Both of them are strong trends, but short-term weakness means you most likely can get in at a better level today. What do you think about these two stocks, Apple versus AMD? Which do you think presents a better opportunity here and why? Drop a comment below and let me know. For Market Misbehavior, I'm Dave Keller. Be well, stay safe, have a good one.